Oh, hey everyone. Sorry, I just got off the phone with J-Pow. Woo! He says this is big, folks. Look, the last CPI report that we got was actually pretty good. We finally came off this summer craziness, and we finally got something that's like, oh damn, inflation can actually go down rather than just straight up. And yeah, that's what we got. We got inflation that actually started coming down last time around. Well, J Pow, when I just got off the phone with him, he told us, obviously, because he talks to me on a daily basis, because, well, he's my daddy. He told us that, look, we need multiple reports of low inflation. That's what we need. We need multiple reports. We can't just expect that one little dinky report in August pointing to July is going to somehow be the end of inflation. We need multiple reports. The thing that's actually quite beautiful is this is what we've been talking about for probably 8 months. If you're around here, you know this is true, that we've been talking about this idea that we're waiting for the August and September data. And that's what we're getting now. Today is actually the first day that we are getting the August data. I think I've said August and September data for like a year because we would lap these crazy Delta variant numbers of last year. That's a big deal. And really, August is the first month that we actually lap the Delta inflation numbers of 2021. That's insane because last August, it doesn't actually feel that long ago, but it's insane because I was preparing for a debate to kick the butt of the governor of California and actually wake him up. Now, I didn't win, obviously. But hey, I think we did really well. We got almost 1 million votes. We beat Larry Elder in San Francisco, and it was fun. But anyway, boy, oh boy, this is a big report. Okay, this is a big deal. And the report that we're expecting comes out in exactly 2 minutes. The important thing here is, again, this is the first of the reports of August or September data that we've been waiting for. Remember, these reports always look back 1 month. And so that makes that pretty important. Now, I do want you to know that even if right now we get a good report, the Fed's still going to come out and they're going to talk dirty to us. They're going to talk to us like, hey, 2 reports is great, but we've still got more work to do. And there's a reason they're doing that. A lot of people email me, they text me, they send me messages on Discord, and which you can join Discord, by the way. Just go to metkevin.com/chat. But they ask me pretty regularly, hey, Kevin, why is it that if inflation is going to go down, why is the Fed being so mean to us? Hold on, let me make sure this is on. Oh, yeah, okay, we're good. Why is the Fed being so mean to us? Why is it like they're constantly trying to bag on the market? And the reason for that is very, very simple, folks. There is something called a data set of inflation expectations. Inflation expectations are really, really important for the Federal Reserve to manage, and that's what they're doing by constantly trying to bag on the market. They're really just doing their job. So don't blame my daddy, J Pow. Okay. Now we're going to get the data in about 20 seconds. But I do want to read you this because I think it's very important that I honor my supporters. Forget haters and losers and spammers and people who just have no life other than hating. And so shout out to Andrew, who says, I'm on property number 3 since I took your course 1 year ago. I watch a ton of real estate content and I'm always learning more, but you really do cover it all in your real estate course. Check that out and use the coupon code linked down below. Now, CPI. And the actual data is, month over month comes in hot. 0.1. It comes in hot, folks. Everything is hot. 0.1 for the month over month. We were expecting negative 0.1. I mean, it's good, but it's hot. If you exclude food and energy, we missed. We were expecting 0.3. We got It comes in hot, baby. And the year over year comes in hot as well at 8.3 versus 8.1. All of the numbers just came in hotter than expected. Now we're going to go through the actual documents in just a moment, but the NASDAQ is down 1%. I mentioned yesterday in my video that if we got a really bad report, we could potentially see this inflation reading drag the market down by as much as 3% today. Folks, right now the NASDAQ, it went from negative 1% to now negative 1.5%. The market is falling on this. This is not the best report we were looking for. We were looking for a negative number today. And unfortunately, that's one of the problems with expectations when it comes to these economist reports is, hey, like, you know, like this is actually, if you think about it, a very good report. The problem is we were expecting it to be even better, right? And unfortunately, when you expect something to be one thing and then it's not, you get a little bit disappointed. NASDAQ now down 1.6%. Let's go ahead and actually look at the document. So we've got that 0.1% increase in month over month inflation. We've got that 8.3% headline. We've got these increases. Take a look at this. The increases were mostly offset by a 10.6% decline in gasoline. And that follows the fact that we have increases in shelter costs. Remember, folks, what do we talk about regularly here? By the way, NASDAQ now down 2%. Tesla matching this at 2%. You've noticed, by the way, Tesla trading very, very similarly to the NASDAQ recently. But anyway, shelter, folks, you got to pay attention to shelter. Shelter is a lagger when it comes to inflation. Remember, folks, the Fed is raising interest rates. When they raise interest rates, you're actually pushing up the cost of housing. It's called inertial inflation. The Federal Reserve is making inflation worse by raising interest rates because it increases rent prices because less people can afford to buy a home. It's pretty ridiculous. Now, we're going to keep going through this report, but I have to give a quick shout out to StreamYard for sponsoring this and allowing me to be live, not only here, but anywhere I want to be, where I could be multi-streaming. Go to metkevin.com/StreamYard to learn more. Okay, continuing with the report here. So the index for all items less food and energy rose 0.6%. That's hot, folks. That's an annualized rate of 7.2%. That's not Gucci. That is not Gucci. It is a problem. The indexes for shelter, medical care, housing, furnishings, operations, new vehicles, education, motor vehicle insurance were those that increased the most. That's not good. This is a broad-based sign that inflation is unfortunately still rampant in our economy. It's not just housing either. It's, quite frankly, everything. So let's see here. Reading the suits really quick. Sometimes they beat me to this. If there was any doubt about the Fed hiking by 75 basis points on September 21st, that's gone now. That 75 basis point hike is pretty much guaranteed for September. No pause for September. The dollar is now rising. Bond market is getting hit hard by the, oh man. Let's look at the bond market really quickly. That's a big deal, folks, because the bond market creates pain for inflation, for the real estate market. Oh my gosh, look at that, folks. Holy smokes. The 10-year treasury is now up 0.6%, all the way up to 3.42. This is insane because that right there means we are knocking on the door of 6.5% mortgage rates. That is a big deal and creates permanent damage for the housing market. It is exactly why I'm creating a startup that accredited investors can now join me in on. This is obviously not a solicitation. Go to househack.com to learn more. But what's really incredible is that if you are an accredited investor, you could get in with founder shares, 1-to-1 valuation. And you could learn more at househack.com and read the prospectus. Okay, so let's see here. There were some indices that declined in August, including airline fares, communication, used cars, and trucks. Interesting. But again, still that broad-based decline hurts me when I see this, or that broad-based increase right here. That is, there's no way Daddy J Pow is going to look at this and go, oh, it's just one thing. You can't just blame one thing here. So unfortunately, even though we're lapping those Delta numbers of last August, this is not good. This is just not good. So let's go ahead and look at some of the other notes here that we've got. Okay, so this is the food index. Food index increased 0.8%, the smallest monthly increase since December of 2021. But 0.8%, folks, that's still pretty dang high. 0.8% is 9.6% annualized. To get an annualized number, you multiply by 12. You do not do any kind of compounding. Okay, very important. Food away from home index, 0.9%. The suit saying one of the biggest culprits in the much larger than expected core CPI print was the tiny decline in used car and truck component. It fell by only 0.1% in August after dropping by 0.4% in July. Analysts were looking for a bigger downdraft in used cars than we actually got. That's very interesting. And listen to this, folks. This is one thing. So basically, they're saying analysts were expecting used cars to fall more than they actually did. Now, something that does bother me a lot, and I've been talking about this pretty regularly as well, is that the analysts just straight up suck. Out of 67 forecasters in the Bloomberg CPI forecast, only one person got it right, folks. Only one person. And it was a person from Berlin at the Sparkasse. In case you don't know what the Sparkasse is, it is a German bank. 10-year treasury yield now up 7.3 basis points here, up to 3.43. This is going to start causing permanent damage to the real estate market. Okay. Oh, yeah. We could be seeing the start of a prolonged real estate downturn, not kind of a short-lived downturn. So this is actually the time to start buckling up and preparing to invest. But it is not time to invest in real estate yet. In my opinion, not financial advice for you. While I'm working on becoming a financial advisor, I am not a financial advisor for you. Passed my test and we're registering. We've already filed paperwork, but we're very, very excited. Anyway, the index for airline fares continued to decline in August, decreasing 4.6% after falling 7.8% in July. See, look at this. So you still have a decline in airfares, but it's just not falling as much as it was, right? And so that's another issue, is that numbers that were going down just aren't going down as much. For those of you concerned about Social Security, CPIW came in at 8.7% over the last 12 months, and CPIU increased 8% over the last 12 months. Okay, let's go ahead and take a look at some more of these tables here. So what I'd like to do is I want to look at some of the details, and we'll look at a little bit more of what the suits are saying. Okay, so I want to look specifically at the month-over-month changes for July to August. This is going to be the far right column. So we're going to look at the far right column, and let's try to understand what happened here. Okay, so apparel up 0.2%. Men's apparel down slightly, women's apparel up. So women are getting charged more, men are getting charged less. Got it. Tools and hardware up 1.4%. Those are unacceptable numbers. You know, if I'm JPOW, I'm looking at this going, dude, how are tools and hardware going up 1.4%? Like, construction's supposed to be slowing down. Why are we still seeing 1.4% on the month over month? Folks, that's over 15% of an annualized inflation rate. That's bad. How are tools still going up that much? Appliances down 1.2%. So we're seeing those durables get hit. Furniture and bedding up 0.5%. Window coverings. Why? Window coverings and other linens up 2.3%. That's bad. This is not good. You've got, let's see here. Here we go. New vehicles up 0.8%. How are new vehicles up 0.8%? Again, that's 9.6%. Oh, snap. I'm just getting a note here from the suits. The rent components were up big. A blended average of owner's equivalent rent of residences and rent of primary residence was up 0.72%, which was the biggest print yet of this cycle. Ouch. Yikes. Okay, yeah. So owner's equivalent rents, which we're going to get to in just a moment, Really big deal. Here we go. Look at this. Shelter, rent of shelter. There you go. Look at those numbers on the right side here. 0.7%. That is the largest that we've actually seen yet on rent in this entire inflationary cycle, especially when you actually go into the detail of it and you see that it's at 7.2%, which is slightly higher than how they round it here. But anyway, that's a big deal, because now remember, as interest rates go up, you decrease the opportunity for people to actually purchase properties, which means you're forcing more people into renting. When you force more people into renting, what do you end up with? You end up with a situation where you have more inflation for rents. This is going to take a while to drive down rents. The longer it takes, the more of an opportunity we're going to have to buy real estate at really good deals. Again, exactly why I'm starting my company, my startup at househack.com. Househack.com. I got that domain in 2019, and I'm really happy I got it. Medical care services up 0.8%. Dental services up 1.7%. This is bad. It's broad-based inflation. This is bad. Hospital services up 0.6%. I am not finding really anything to be happy about in this report so far. This, by the way, comes just hours before Biden makes remarks at the White House touting his inflation reduction measures. Hate to say it, but the Inflation Reduction Act of 2022 is a joke. That's the Biden Inflation Reduction Act. While it was, there were some benefits of obviously their plan, it's not something that is actually expected to impact inflation. In fact, Wharton saw a negligible to zero impact on inflation from that. Again, biggest driver here: used vehicle prices and rents. Those are the biggest drivers of the inflation here. Used vehicle prices not falling as much as we thought. Let me just do a quick look here so we can see the line. Here we go. Used cars and trucks, folks. Used cars and trucks. Here it is. Last month fell 0.4%. We were expecting more of a drop here because remember in the summer, we got a 1.6% bump in this, and that really hurt us. That really helped drive in this hot inflation report of the summer here with that 1.6% line at the top of the screen now. It came in at negative 0.4% last month, and analysts were really hoping that this number would come in even lower for this month. But unfortunately, it came in at only a drop of 0.1%. So we didn't get that sort of anchoring of inflation to the downside. Not so great at all, honestly. Right. Taking a peek here again at what the suits are saying. So again, rents, used vehicles, big deal. Let's go ahead and take a brief look at the 5-year break even. These are inflation expectations as dictated by the market. Very, very big deal to know what's going on with inflation expectations. It does look like they are rising today. One moment. Oh yeah. Okay. So we got a little bit of a jump here, but honestly, inflation expectations, they show us that we should be expecting a little bit of a volatile path down on inflation. With the inflation expectations chart is up on screen now, and you could see inflation expectations here peaking in March, especially with what we've got going on with Ukraine. And you've got these weird sort of like declines, and then you've got these weird spikes, right? You got a spike here, you got a spike here, you got a spike here. Usually inflation expectations precede what's going to happen with inflation by approximately 3 to 4 months. And you can see we're really expecting inflation expectations to plummet. But unfortunately, we're in this situation where even though we're expecting inflation to plummet, it's not doing that great of a job just yet at really giving us a consistency to the downside. Folks, yesterday I warned you that if we got a miss, we could see the NASDAQ fall back to 300, dropping as much as 3% today. Presently, the NASDAQ is down 2.35%, down to 303. 300 was approximately the target of where I thought the NASDAQ would go if we got a bad print today. Unfortunately, it's essentially trending there. You've got Etsy down 4%. You've got NVIDIA down 4.4%. Tesla's down 3.5% on this news. Keep in mind, if you like what you see in this application right here, this is the Webull application, and they're currently running a promotion where you could get 12 free stocks for signing up. That could be worth thousands of dollars in free stock. All you have to do is go to metkevin.com/Webull. That's Webull. I think you could also go to metkevin.com/free if you want those 12 free stocks. They all point to the same direction. Affirm down about 6% on this news here, sitting at about $25. Embraer, the airline company from Brazil, falling about 6%. Brazil experiencing substantially more inflation than the United States. But folks, today's not a good day for suggesting that the United States has really has any kind of handle on what's going on with inflation. 10-year Treasury yields retracing down again a little bit, sitting right now at 3.414%. This is still very high, though, and being up 5 basis points, big issue for real estate. Although I hate to say it, I'm just going to give you my bias, okay? This is just totally my bias. The more I see this number go up, the happier I get. Not because other people are going to lose money, but because I'm going to be able to buy some really good deals with househack.com, which I'm very excited about. Now, do pay attention to the day chart on the NASDAQ. And I want you to really think about this, okay? This is the day chart on the NASDAQ. Yesterday with course members, we were talking about how in order for us to, in my opinion, really get all the way back down to what we had in June, we would have to have really bad like inflation reports, okay? Even though today's inflation report isn't great, honestly, if we just ignore what the analysts were expecting and actually consider what's really happening in the inflation report, which is really an unprecedented inflation report, inflation being up 0.1%, not that big of a deal. It's okay. We are expecting rents to go up. That's going to happen. This isn't that terrible of a report. I thought if we were going to have a bad report, it was going to be bad. This isn't that bad. Like, at least it's trending down, right? Now, don't get me wrong. 8.3% is still a problem. And I don't want anybody to think that, oh, well, Kevin, you don't think it's bad that poor people have to pay more rent or more for food or, whatever. No, don't get me wrong. That's a problem. The inflation issue we have is a problem. However, it's unprecedented, at least something that we haven't seen since the 1970s and certainly haven't seen following a pandemic anytime recently. And this is really a once in 100-year cycle here. So it doesn't surprise me that analysts have absolutely no freaking clue what they're doing. This is probably the hardest market to really be a part of. It's so frustrating, right? So if you're feeling frustrated about what's happening in the stock market, you are right to feel frustrated. It is very, very difficult. And anybody making any kind of predictions in this market, honestly, is just brave, because most people won't put their head on the line and make predictions because they're afraid of being wrong. They'd rather just tell you, go buy an index fund. That's fine. That's the smart thing to do on social media. That's the smart thing to do. You make predictions, it's a problem. But anyway, going into making predictions, I believe, and again, this is a risk, right? I believe that in order for us to go back to these June lows, we would have to see like 10% inflation. We would have to see inflation not go from 8.7 to 8.3%. Oh, it didn't fall as much as we thought it would. It's still falling though, right? We would have to, in my opinion, see inflation go back to like 10% or 11%. And then, in my opinion, we would actually create new lows. Think about that, folks. New lows. New lows would be kind of like in that Titanic video I made where I'm like, oh yeah, this could go even worse. And if you go through my Titanic videos again, if you type into YouTube, Meet Kevin Titanic, you'll actually see in one of them, I put a little bit of a hint in terms of how far I thought the SPY, the S&P 500, could fall. SPY is obviously an ETF that tracks the S&P 500 and enables you to invest in the S&P 500. Nobody really invests in the S&P 500 directly. You use some form of ETF that is index tracking to invest. Now, again, I really do believe, and this is just my opinion, again, very dangerous to provide opinions on the internet. I believe we need to get to about 10% inflation to hit new lows here. Otherwise, I strongly believe we're going to teeter between this section right here, the 23.3% Fibonacci retracement and 38.2% line. Now, if you have absolutely no idea what that fancy word is that I just said, all it is drawing a line between the tippy top that we had in December and the bottom. Actually, that's the end of November, and the bottom of the market here in June. And then we can kind of trace what the market is doing in the meantime. And there's this big yellow line here at about 319 because that's been a pretty strong shelf for our market. It really marked the bottom of the market multiple times, but it got it wrong. The yellow line was wrong. The bottom of the market actually ended up being around that 268 when we had really peak fear for a while. Keep in mind, when it comes to retail buyers in the stock market, we are still seeing positive net inflows from retail. So we have still not seen retail capitulation in this market. That is actually leading a lot of people to say that, Kevin, in order for us to hit new lows in the stock market, we actually need to see retail capitulate. And when retail capitulates, that's potentially indicative of the bottom of the market, nothing else. That's what some people say. I don't necessarily agree with that because I think retail is very, very smart. I think retail has learned that the time to invest is during a recession. The time to, which is what we're in now, at least technically, the time to invest is during pain. And so I think retail is actually doing very, very smart things right now. Make a Titanic video NFT. That's funny. You think they would do 100 basis points? Let's go ahead and look at what we think the Federal Reserve is going to do, not based on what I believe, but rather based on what the market believes. So the bond market presently is pricing in the potential for no, 100's not on the list right now. No, actually, let me correct that. Hold on a sec. Hold on here. Let me do the math here. So we're at 2.5% on the Fed funds rate right now, but I want a Fed funds range. Let's see here. Okay, so today we're at a range of 2.25 to 2.5. That's the current range where we sit. Let me do this for you so you have this written out a little clearly, okay? So today we're at 2.25 to 2.5. That's the range of the Fed funds rate, right? So this gives us the target where the basically banks should be borrowing from each other for at overnight rates in the market. That's the Fed funds rate. The discount rate is what banks can borrow from the Fed for, but we just talk about the Fed funds rate. I call it the F rate because when we talk about it, we're like, oh, F, at least in this market. We currently expect a 75 BP hike, basis point hike, with a probability of 81% at the moment. However, there actually is now a 100 basis point hike being priced into the market, and that is sitting at about 19%. There is at the moment a 0% chance of a 50 basis point hike being priced into the market. So that's gone. That's completely gone. Roderick, what's up, my friend? Thank you so much to see you again. Really appreciate you. Yeah, I think it's also very important for folks to remember because some people think, oh, Kevin's being flippant or whatever. I think they're either not paying attention or they're just purposely trying to be haters. I said in my last video that I will return when I launch my real estate company. I have followed exactly what I said I was going to do. I said I was going to leave and come back when I launched my real estate company. I launched my real estate company, House Hack, and now I'm back. Hey, that rhymes. It's also what I said in January, right? I think this is very important. I said, I'm going to sell and I'm going to rebuy in about 60 days. That's exactly what I've done. So really, I try my best to be the most transparent on YouTube. Unfortunately, I think either sometimes people aren't paying attention or nuance, evades people who have a low capability of paying attention, and it's quite frankly, it's unfortunate for them. Obviously it sucks for me, but what I need to do is I just need to pay attention to the lovers and not the haters. Earlier this morning we pitched that Andrew here gave me a beautiful shout out in our course member live stream about how he's on property number 3 right now after taking my course a year ago, and how he thinks my real estate courses have more content than anything that he's found ever before on the internet. And I really believe that's true. You know, some people like to say, oh, you could just Google information. Well, you can't Google information, A, if you don't know about it, and B, a lot of the stuff in my courses you can't find on Google because it's stuff that I've created. These are ideas or processes that I've created, and those are obviously the ideas and processes that we're going to capitalize on substantially with househack.com now accepting accredited investors. Read the prospectus. This isn't a solicitation. Okay, so what we can see here going into the market open, we're about 35 minutes from market open, is actually a further deterioration here. You can see the substantial volume that we got in the NASDAQ going into market open here. You can see the volume is starting to decline. Unfortunately, that decline in volume is not actually helping us. If anything, it's hurting us right now. You know, it's very likely, in my opinion, that today is going to be a down 3% today in the market. Again, that is exactly what I warned could happen yesterday. I obviously did not know what would happen with inflation today. I just figured if we had a miss, we would be down back to 300 on the NASDAQ. Now, in my opinion, if you the way to look at this is twofold. Number one, if you are somebody who is capable of being in this market longer, and you're you're able to ride the waves here, maybe this creates another buy the dip opportunity for you, right? Obviously, if you're looking to diversify away from the stock market, I do think there are going to be some huge opportunities to come up in real estate. And I will never tell you not to do real estate yourself. Obviously, I would love if you're an accredited investor to invest with me at HouseHack, but I'm never going to tell you not to do real estate yourself. I think you can make the most money doing real estate yourself, buying your own home as a wedge deal, buying your own rental property as a wedge deal, turning your home into a rental property as a wedge deal. And I just want you to know that I've been talking about this real estate crisis coming. I was the first since January. And this isn't to like brag or pat myself on the back. It's just to say that I see the signs daily. I'm probably one of the only real estate brokers, right? Remember, I am a real estate broker who's dealing with the real estate market on the daily basis, looking and going, yeah, no, we're going down. Okay, and I don't want to be the person that's like, oh no, and it's just a minor little correction. That's the same thing people said in 2006. Don't worry, it's just gonna level off. Not if the 10-year treasury yield continues to rise the way it is. It's unfortunate. Anyway, NASDAQ obviously decaying here a little bit longer. We're now down negative 2.66%. We do have the suits. Let's go ahead and take a look. One more look at the suits saying here. So, oh, how interesting. What is this? Fed funds rate upper bound here. So there is a Bloomberg economist who actually suspects the Federal Reserve could raise rates as high as 5%. And if you're wondering what the market is pricing in, I want you to see this particular chart here. The Bloomberg economists are projecting a 5% upper bound for the Fed funds rate here, peaking somewhere in about mid-2023, folks. Right here is where you want to buy real estate. And I can actually drag this out to the right a little bit. This is where you want to buy real estate. When we get peak interest rates, and then they stay at peak for a while, and then probably when they start turning down. That's like when we ring the bell and we say, buy. That's not now, okay? Like we're here, okay? So we still have a lot of work to do with the Federal Reserve to actually get this broad-based inflation down. Dove ID, thank you so much for mentioning that. Let's see here. Mustafa, thank you so much for the comment here. Honestly, I don't get the hate. Been following for almost 2 years, always transparent, always sharing. Course membership helped me reach new all-time high. Hell yeah, let's go. You encouraged us during the Tesla horse handy dip. Yeah, thank you. Good to see you live again. Thank you. Oh, Thank you so much, Ted. Ted just donated $13.99 Canadian dollars, so this is basically worthless, and says, I got depressed trading without you. Feels good seeing you back. Thank you so much, Ted. You probably know my father-in-law, Bill, since he's Canadian, so I'll tell him you said hi. And I'm just kidding. Thank you so much for the $14. It's very nice. Okay, so you always got to make fun of your neighbors. That's the way it works. Okay, I do want to see what the other suits are saying right now outside of the CPI department. So 2-year Treasury yield jumps to the highest level since 2007. Woo-hoo! We can also look at the 210 curve, which is a bond yield spread. The 210 curve is generally what we use to measure whether or not we have an inverted yield curve. Oh boy, do we have an inverted yield curve. The 210 has been inverted. It first inverted April 1st. At first, we thought it was a joke because it inverted April 1st. I kid you not, it inverted April 1st. But no, folks, it was not a joke. We have been inverted since July. That is any number here within the box is inverted. We are at about negative 30 points here on the inverted yield curve. Yikes. Let's see. What will Biden whisper today about inflation? Well, I suppose it depends what was written for him. All right. Whew, we got the burns today. Sorry, that's bad. It's bad. Okay. This is not a political video. Anyway, all right. So August consumer price data beats estimates. Overnight swaps now pricing in a 79 basis point hike from the Fed. Obviously, that would turn into 75, not 79, but that's just the market. The market doesn't round by 25 BPs. Shout out again to StreamYard. Go to metkevin.com/StreamYard for multi-broadcasting software and software that lets me hold up or throw up comments like Sean's comment here saying that was a savage burn, or Steve going burn. I'm not sure if that's Dell Steve over here, but there's a course member Steve who always tells me to buy commodities and go long on Dell. The last thing I think about is going long on Dell. I got to get off the internet today. So anyway, we are almost down the full 3% that we were expecting here. Tesla now down a little bit further than the 3% Nasdaq, but we're almost at 300 here, and so oh damn. Okay. Anyway, yeah, that about does that. Zachary here donating $10 to say, what do you think about buying investment properties right now? It is not something that I would do. In fact, again, right now, just for accredited investors, but I do expect that in the future, we'll be able to open this to non-accredited investors. The SEC process just takes a whole lot longer. So it's not up to me. It's up to the Security and Exchange Commission. So I don't want anybody to think I'm purposely leaving people behind. But personally, I believe that as this 10-year Treasury yield rises, now's not the time to be investing in real estate. I think now's the time to be waiting. This isn't personal financial advice for you. But what we're going to do with HouseHack is we're actually going to build our war chest, right? We're not going to be buying right away. And we're going to build our operations in different cities. So think about it as sort of building outposts in about 5 different cities throughout the country as the real estate market comes down. And so that way, once we see indicators that suggest the real estate market has bottomed and is actually starting to turn up again, we already have outposts in about 5 different cities, and we're able to strike in multiple different cities at the same time. And so that's what we're doing over at househack.com. Again, now open to accredited investors. So, all right, that about does that. Thank you very much, everybody, for being here. If you liked me being live, leave some love in the comments down below. I will look for it. I appreciate you, and thank you. Goodbye.